Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Hello. Welcome to another episode of Reverse Mortgage Radio. I'm your host, Bruce Simmons, your reverse mortgage professor right here in good old Colorado. Every week on this show, we talk about the home equity conversion mortgage, which is better known as just simply a reverse mortgage. The home equity conversion mortgage is simply the name of the FHA-insured reverse mortgage program. And that's what we're going to be talking about today is the reverse mortgage that FHA insures. And normally, when most people think about reverse mortgages, they think no monthly payments, right? That's the biggest benefit for most people, and that's absolutely true. But a lot of people don't know that you can make payments. Even though I talk about it, I mention it, I should say. I don't talk about it until today. But most of the time I mention you can make payments if you want to, and there certainly are benefits to that. But today, we're going to talk about what those benefits are. Because as long as you live in the home as your primary residence, you pay your property taxes, keep your homeowners insurance in place, maintain the home, and keep your name on title, no payments are ever required on a reverse mortgage, and nobody can ever call the loan due. But some people like to make mortgage payments. I shouldn't say like to make mortgage payments. Some people like the benefits of paying down their reverse mortgage balance so that they have more money later. And we're going to talk about all those benefits today. We're going to talk about what normally happens when you do not make mortgage payments. We're going to talk about what happens if you do make mortgage payments, how those payments are applied in something called the prepayment waterfall. And that's important to know if you ever want to deduct the interest that you actually pay. Most of the time, this loan is what I call interest neutral. There's no deducting the interest, but you don't pay taxes on the money that you're charged. So there's a certain way to do it, and we're going to talk about that, okay? And we're also going to go over the detailed benefits of making these voluntary prepayments. And then finally, we're going to give a quick word of caution about how much you should pay if you want to keep the line of credit in place and have the loan balance as low as possible. However, as you know, before we could dive into today's topic, we do need to talk briefly about what a reverse mortgage is and give a quick overview of how it works, okay? In a nutshell, a reverse mortgage, most of the time, is an FHA-insured reverse mortgage program. And there are non-FHA-insured loans that we're going to talk about here in the next week or two. I'll mention about how those other programs and compare them to FHA-insured loan. But today, everything we're talking about is about the home equity conversion mortgage, which is the FHA-insured reverse mortgage program. It's called a HECM, HECM. And in a nutshell, that's a loan that's specifically designed for people that are 62 and over. It allows you to convert a portion of the value of your home into money that you can spend. Because as you know, if you've got $500,000 tied up in the equity in your home, it doesn't do you any good unless you can convert it to cash, right? Now, maybe you don't need to convert it to cash, and then you're great. And you're thinking about a reverse mortgage for maybe later on. But there are benefits to converting it to cash today and keeping a line of credit in place as well. And we may touch on that too. But basically, a reverse mortgage allows you to convert some of the money into cash from the value of your home. And then you can spend it how you want, and you never have to make a payment. No payments are required as long as you pay your taxes, insurance, maintain the home, keep your name on title, and live there as your primary residence. The loan never comes due unless one of those 5 things happens. If you're married, the last homeowner that's living in the home, when the last homeowner passes away, that's when the loan comes due. So if you're married and one of you passes away, unfortunately, the other one can stay there worry-free without having to worry about ever making a payment. Just do those 5 things we just mentioned. Now, you are still charged interest on the loan. And I kind of teased it earlier, but basically, no payments are required, so you don't pay that interest out of your pocket. What happens, the interest gets charged every month. You're charged interest and mortgage insurance. Because this is an FHA-insured loan, and FHA stands for the Federal Housing Administration, every single FHA-insured loan has mortgage insurance on it. Mortgage insurance protects the lender in case you ever default. On a traditional mortgage, that's when your loan balance is high. So you borrow 95% of the value. Once your loan value drops below 80, you can refinance and get out from under that payment of the mortgage insurance. With a reverse mortgage, we don't know how much you're eventually going to owe because the loan balance grows over time. It gets larger every month if you don't make a payment. And so that insurance has to be there no matter what your starting loan balance is. If you're starting out, you got a $600,000 value on your home and you're only borrowing $25,000 to start, you're still charged mortgage insurance because 20 years from now, you could owe more than the home is worth. And that protects the lender, which indirectly, it protects you, your estate, and your heirs. Because the reason mortgage insurance is involved is if the lender loses money on the home, they file a claim with the mortgage insurance company. The mortgage insurance company would pay the lender. So they really don't lose money. And because of that, they're not going to come after you, your estate, or your heirs. So let's say you live in your home for 20 years after getting this reverse mortgage, and the value happens to drop. It gets dropped in half just at the time that you're ready to that you pass away. You leave the home to your heirs, and now more is owed on the house than is worth. If that happens, your heirs don't have to worry about it. They sign the house over to the lender and they walk away. There's no equity left in the home, but no money has to be paid by them or your estate. So because the mortgage insurance company will sell the house for whatever the mortgage company will sell the house for whatever they can get, and the mortgage insurance will pay the difference. So the lender's not going to lose money. They're not going to come after you, your estate, or your heirs. All right. So that's kind of how that works. And you're charged it. And that's part of what we'll talk about here in the coming minutes. Okay. So let's talk about now how a reverse mortgage works. However, before that, if you have any questions about reverse mortgages in general or anything, give me a call, please. You can reach me directly. You can call me on my cell phone number, 303-513-2748. 303-513-2748 is my direct line. That's my cell number. And my website, if you want to learn more information without talking to me, is reversemortgageradio.net. Reversemortgageradio.net. You can download a free consumer guide. You can get a free quote, all that stuff. It's great, good information. So let's dive into this. What happens traditionally when you do not make any mortgage payments on your reverse mortgage? You get it in place and you make no payment. It's designed so that you don't have to make payments. We call it kind of payment optional, if you will. And that's probably the main attraction with reverse mortgage. So every month you're charged 2 things. You're charged interest and mortgage insurance. Mortgage insurance is charged on an ongoing basis. It's part of the closing cost up front, but then you're also charged 0.5% of the loan balance per year. Let's say you have a $100,000 loan balance. Over the course of the year, about $500 gets added to the loan balance. So if you didn't take any more money out of line of credit and you're just enjoying not making payments, you're going to see your loan balance grow by about $500 from the mortgage insurance by itself. Now, that's not exact because you're charged it every month and there is compounding involved. I'm just rounding things off. Then you're also charged interest. So if you're charged interest, let's say the interest is 6%. You're charged 6% interest and 0.5% mortgage insurance. So a year from now, the interest would be about $6,000. The mortgage insurance would be about $500. Your loan balance will be, a year from now, $106,500. roughly. It'll be a little bit more than that because of compounding, but that just gives you an idea. And so think of it like running up a tab at a restaurant. Instead of paying the bill after each meal, the waiter just keeps a list of how the money's been growing over time. And every time you eat, that tab gets a little bit bigger. And that's the way a reverse mortgage works. The balance grows and it's settled later after the last homeowner permanently leaves the home or passes away. Your heirs inherit the home, and they typically will sell the home because there's usually a lot of equity left. Let's say they sell the home for $600,000 and you owe $400,000. Then they sell it for that. They pay off the $400,000 that's owed, and they inherit $200,000. Now, if you only owe $100,000 on the loan, then they sell it for $600,000, pay off the $100,000, and they keep $500,000. Whatever the difference is goes to your estate or your heirs. Now, if you're upside down, that's where the mortgage insurance comes in. So the house is only worth $500,000, but you owe $600,000. In that case, your heirs can just sign the house over to the lender and walk away. Or they also have the option, if they want to keep the house, they can get a loan for 95% of the value, the $500,000 value, even though $600,000 is owed, and the lender has to accept that new amount. Okay, now let's talk about what happens when you do not make payments on the home. Okay, or excuse me, when you do make payments on the home. Let's flip it, okay? Instead of your balance growing every month, you're pushing it back down. And here's the neat part. When your loan balance is lower, your line of credit actually grows more into the future. So let's say you're charged, let's just say you're charged $1,000 in interest and principal on whatever your loan balance is. That's how much your loan balance is going to grow this month. It'll grow by $1,000, but you decide to pay that $1,000. Now your loan balance is going to stay the same, exactly what it was. But that $1,000 you just paid gets set aside. You can tap into it at a later date. So let me touch real quick, back up, because FHA dictates to us, the lender, how much we're allowed to loan you, and is based on your age, the value of the home, and the interest rate. Let's say we could loan you $250,000, but you only want $100,000 to pay off your existing mortgage. Well, that other $150,000 gets set aside. You don't have to take it. You're not charged interest on it, but it gets set aside in a line of credit. That line of credit is going to grow regardless. If you never make a payment, the line of credit grows at the accrual rate. So you're charged 6% interest and 0.5% mortgage insurance. Your line of credit is growing at 6.5%. You're being charged 6.5% total between mortgage insurance and interest. Your line of credit also grows at 6.5%. So that $150,000 is growing at 6.5%. Now, let me be perfectly clear. You are not earning interest on that line of credit. Okay, I hate when people say that. It's just my little pet peeve. But you're not earning interest. It's not free money. That line of credit grows. Let's say it grows from $150,000 to $200,000. Now you've got $50,000 extra in there, and you're thinking, well, let's just pull that $50,000 out, and that'd be great. We never have to pay interest on it. No, that's just allowing you to borrow, access another $50,000 of your equity. But if you pull that money out, it gets added to the loan balance. And so you're charged interest on anything you take out. I like to equate it more to a line of credit or a credit card that increases your credit limit. You've got an $8,000 credit limit on your credit card, and you've used $2,000 of it. So now you owe $2,000. You have $6,000 available because you started with an $8,000 credit limit. If the credit card company increases your line of credit to $9,000, now you've got $7,000 available. You still owe $2,000, but you're like, hey, great, let's pull out that $1,000. And you take the $1,000. Now your line of credit, the amount of money available to you in that credit card drops back down to $6,000, but your loan balance grows by $1,000 because you're borrowing the money. And that's exactly how the line of credit works on the reverse mortgage. Any money you take from the line of credit gets moved over to the loan balance, and you get charged interest and mortgage insurance from that point forward. However, when you make payments on the loan, any amount you pay. Let's say you're charged $1,000 this month, but you only pay $200. Well, now you're still charged $800, so your loan balance will grow by $800. That $200 you paid gets moved over to the line of credit. It lowers your loan balance by $200,000, but it gets added to the line of credit by $200. So that's kind of how it works in a nutshell. Any money, every dollar you put in towards the loan balance reduces the loan balance or the amount you would be charged. It wouldn't increase as fast, but it gets added to the line of credit so you can access it at a later date. It's perfect for, let's say, somebody that's in commission sales. Let's say you're a realtor or you sell insurance and you're still working, but you've got this big mortgage payment and you have to pay this $1,500 mortgage payment every month. You get tired of it, because you got to sell so much to make that money to pay that. Wouldn't it be nice if you didn't have to meet that payment every month under risk of foreclosure? Because if you don't make that payment, you could lose your house, right? On a traditional mortgage. You get a reverse mortgage. Now you're not required to make a payment. And let's say you don't get a sale for a couple months because you're in real estate. Maybe you want to slow down. So now you're only selling a home every other month or every third month. And when you sell that house, you make $8,000 or $10,000. Well, hey, that's awesome. Let's put that money towards the line of credit or towards the loan balance. So now you pay $10,000 towards your loan balance. You didn't make a payment for a few months, but now you pay $10,000. That 100%, every penny of that $10,000 gets moved over to your line of credit. Your loan balance, whatever it is going to drop by $10,000 as well. So you're charged less interest on the loan, and your line of credit has grown by $10,000. So that's now growing at a faster pace because you've got more money in there. And then you can tap into it anytime you want. Now, there are first-year restrictions, which I'm not going to get into. We don't have time to get into all that today. But that's kind of, in a nutshell, how it works. By the way, if you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the Reverse Mortgage Professor right here in good old Colorado. I'm with a company called American Liberty Mortgage. You can reach me directly on my cell phone with any questions about reverse mortgages at 303-513-2748. 303-513-2748. That's my cell number. You can also visit me online at reversemortgageradio.net. reversemortgageradio.net. Go there, download my free consumer guide, gather a lot of good information. You can watch video testimonials. You can read testimonials from other people too. And you can also even get a free quote. Find out how much money you can get from a reverse mortgage. Okay. And today we're talking about the benefits of making payments. No payment is ever required with a reverse mortgage as long as you do pay your property taxes, your homeowners insurance, you maintain the home, live there as your primary residence, and keep your name on title. It's your house. You have to do all those things even if you own the home free and clear, right? You're going to do all those things. You just have to continue to do it with a reverse mortgage. And you can sell the home anytime you want, paint it purple. It's your house. You do what you want with it. Now, other than destroy it. You have to maintain it, obviously. All right. So we talked about what happens if you don't make payments. We talked about what happens when you do make payments. Now, let's dive into a little more of the minutia, I guess, of how that payment is applied. Let's say you do make a $10,000 payment. What happens with that payment? Basically, the first part of it has to go, it pays any mortgage insurance. That gets paid first, then interest, and then principal. Now, it really doesn't matter. Your loan balance is going to drop by $10,000. If you make a $10,000 payment, your loan balance comes down by $10,000. It doesn't matter how it's applied unless you're looking to deduct the interest off your income taxes. If you want to deduct the interest, you have to make sure you pay enough to pay interest, okay? I know, let's say you keep the loan. Let's say you've got a $500,000 home. One of the fees to get the loan in place, people say, oh, reverse mortgages are expensive. Well, not really. They cost more to get in place because of the mortgage insurance protection that protects the line of credit that's available to you if you don't take all the money. It also protects your heirs and your estate if ever more money is owed on the house than it's actually worth, if you're upside down on it, okay? So these protections are only in place because of the mortgage insurance. So mortgage insurance has to be paid. The initial mortgage insurance premium is 2% of the value of your home. You're charged twice. Number one, you're charged in the upfront closing costs. That's 2% of the value of your home. If you have a $500,000 home, that's a $10,000 fee that gets charged up front. Now, none of the closing costs are out of your pocket, at least when you deal with me. We subtract all that from the loan amount. However, if you decide to make payments, that mortgage insurance has to be paid before you can deduct any interest. So let's say you've had this loan for a year and you decide you want to make a mortgage payment. You pay $10,000 and you're going to get $10,000 interest deduction, right? That ain't going to happen. What happens is you have to pay the mortgage insurance first. So you pay $10,000. Well, that $10,000 just covered the initial mortgage insurance premium. Then you've been charged, let's say you've been charged $500 in mortgage insurance during that first year. Well, now there's another $500 that gets added that you have to pay down before anything goes towards the interest. So if you have the loan in place, let's say you just get it, and the first month you decide to pay $10,000, well, congratulations, you just paid $10,000 of mortgage insurance. You're not going to be able to deduct any of that from your interest. Now, I'm not a CPA. I'm not a tax accountant. Talk to your accountant. Okay, I recommend you talk to your financial advisor, your accountant, whoever, because I'm not that. I don't know all the laws. But this is the way I understand it. So you've got to be aware of that. And it really, if you're not going to worry about deducting the interest, and you're only going to be able to deduct it if you have expenses, the way the tax laws are set right now, you have to have like $25,000 or whatever it is in other expenses. Or again, I don't know what the amount is. I'm not an accountant. But I don't deduct because I don't have enough deductions. So I don't deduct the interest on my mortgage. But if you did, that's a possibility. Okay, you just have to pay the mortgage insurance first, and it's the accrued mortgage insurance amount. Okay, so keep that in mind. The nice thing is that $10,000 you pay is going to be moved over to your line of credit. It's going to grow over time, and it will always be available to you as long as you pay the taxes, insurance, and all that stuff. Okay, so that's called the prepayment waterfall. Now let's talk about some of the benefits of not making a mortgage payment. Well, first of all, increased financial flexibility. That's huge. Making payments gives you choices. You could pay a little just to offset the interest, or you could pay more to knock down the balance and preserve more of your equity. Because the lower your loan balance is, the higher your equity is. Equity is just the difference between the value of the home and the loan balance owed. Okay? Think of it like going to a buffet. If you don't have to eat everything, but you can take what you want. And the same with payments. You pay what works for you. If you get a tax refund for $2,000 and you want to apply it to your loan balance, you could do that. Even though you may owe $250,000 on the loan, you could pay that $2,000 and that $2,000 gets moved to your line of credit. And you have availability then, okay? And there's no penalties for skipping payments. This is great, like I said, for salespeople. With a regular mortgage, if you skip a payment or you miss a payment, you're in trouble. Late fees, it hurts your credit. Even you could face foreclosure. But with a reverse mortgage, nothing bad happens. You're charged interest, which you know up front. You have to know that up front, okay? You're going to be charged interest. It reduces your overall cost too, because the amount of interest you're charged drops because your loan balance is going to drop if you make payments. And again, there's no prepayment penalty. You could pay as much or as little as you want and never have to pay anything extra. There's no penalties for paying anything extra. It improves your cash flow. Let's say you make payments on this and while you're working, and then you just keep it all in the line of credit. And then when you're 80 years old, Now you might need some in-home care, or you maybe need somebody just to come in and help cook and clean for you. You can convert that line of credit or a portion of that line of credit into a monthly payment where the lender will deposit money every month into your bank account. It's an amazing, flexible strategy. Take a look at it. It makes total sense. Also, financial planning. This is where the reverse mortgage making payments really shines, because you can use payments as a financial tool. 1 year, if you sell some stock or downsize, you pay, you want to get rid of your car and you sell it, or whatever the case may be, you have some extra cash, pay it towards a reverse mortgage. Now you're charged less interest and your line of credit will grow. You can then tap into it later too, but it also works as a great cash reserve or a set-aside account. Think of it like if your investment portfolio value drops, but you need to then pull some money out. So you've lost 10% in your investments this year, but you need to pull some cash out because you promised to pay your kids' college, your grandkids' college or whatever. Use your line of credit. The money that's set aside in your line of credit, you use that now. And then when the market comes back, you can pull money back out of your investments, or you get required minimum distribution, apply it towards the loan balance, and you pay your loan balance back down. It makes total financial sense. And if your financial advisor says it doesn't, please have them call me. Okay, real quick, don't pay too much. Don't pay it off completely. If you want to keep the line of credit, you could pay it down to like $300, $400, $500, and you're charged almost nothing in interest and mortgage insurance, and all that money will be available in the line of credit. However, if you pay the loan balance in full, you say, okay, I owe $120,000 and 55 cents, and you pay all that money, boom, your line of credit gets closed out. It's not like a HELOC in that you cannot pay it off to zero. If you pay it off to zero, everything gets closed out, the lien gets released, and then if you want to access a line of credit, you won't have it available because it's closed. Everything gets closed out. So you got to make sure that you don't pay too much, especially if you're opening up with a very small balance. A lot of people will they don't need the money now. They just only finance closing costs with a reverse mortgage. So maybe they owe $15,000 or $20,000 or $25,000, and they say, well, maybe we'll just pay that off. Don't do it. Pay it down to $500, and then you're charged almost nothing in interest, but you have all that money growing in your line of credit. Okay, so keep all that in mind. Now, here's the bottom line. Making payments on a reverse mortgage is not required, but it can be a smart strategy. It gives you flexibility. It helps you manage your loan balance, preserves the equity. There could be tax benefits. And most importantly, though, it gives you control of your money and your equity during retirement. That's all for today's episode, though. So please let me know if you have any questions about reverse mortgages. My name is Bruce Simmons, your reverse mortgage professor. Call me with questions. I'd love to talk with you. My number is 303-513-2748. 303-513-2748 is that's my cell number. Give me a call if you have any questions, or visit me online at reversemortgageradio.net. Thanks so much for listening. And until next time, stay informed, stay empowered, and take control of your retirement. Have a great day.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.